I was looking at a report which said that when one looks at the past episodes of more than 300 basis points of rate hikes in the US, only in the 1993-95 period did a tightening episode not trigger a recession. My question to you is your base case of a recession in the US? And if so, what is the corresponding effect or the cascading effect on the world economy at large as a result of that?
The base case is of a sharp slowdown, not an outright recession. I'll talk about why we don't think is the case, but it's on a thin ledge. A recession is not a trivial scenario. It can happen as well. But the base case, let's say with 45% likelihood, and maybe then there's a 30% likelihood of a recession and the 20% likelihood of actually things being better. But just with a 45% likelihood scenario, so not odds on favorite, but definitely the most likely scenario in our view is one where the US economy slows quite sharply across the board. Consumption gets hit by high interest rates. Businesses stop adding to capex, but start running down inventory and actually manage low levels of inventory on expectations of weak demand. And the public sector, as we all know, right now is actually running a surplus. It's not adding to GDP, it's actually subtracting from it. So the C and the G and the I part of the investments of the economy all slow. And the net exports part of the economy start also weakening simply because of the very strong dollar. So around that, we can expect a pronounced slowdown, sequential growth rate of maybe 0, or maybe just a little more positive than that. But that too is more like a 2023 scenario, not 2022. I think there is enough sufficient momentum in the US economy, whether it is from consumption or from business spending, things can be okay in the 2% to 3% growth trajectory for the remainder of the year. Let me give you a couple of bottom-up stories to illustrate my point. The first one is companies are not necessarily scaling back on hiring just yet. We have seen very early signs of some degree of nervousness on the employment side, but nothing that can be taken as a sign of the economy beginning to contract or heading toward a recession. Unemployment remains at exceptionally low levels. We still have companies hiring. Wage growth is substantial. And when we talk about the forward-looking part of the economy, that the doom and gloom would immediately cause companies to stop giving wage hikes or start firing people, you need to take that into the context of the fact that the companies made an exceptional amount of money the last 2 years. Despite the pandemic, we have a large chunk of the economy which had tremendous earnings, very good profitability, and therefore giving a 5, 6, 7% wage increase this year is not that big a deal. The company's employees actually expect it because they know how well the companies did. And the second is the issue of the overall consumption balance sheet, the health of consumer balance sheet. Net debt in the US on the consumer side is about 0. People have seen strong pickup in their wealth gains over the last decade. Housing has done very well. Equity market till a few months ago was doing well. More importantly, they have cut back on their debt. Credit card, housing, personal loans, in all areas, things are nowhere as dire as they were before the global financial crisis in 2008, 2009. So from a balance sheet perspective, the ability of consumers to take high interest rates or some degree of headwinds is significantly greater than it was in the lead up to the global financial crisis. So this is why we're not painting a recessionary scenario quite yet.
Okay. So if that is how the events unfold, Taimur, what's the impact on the APAC or the EM region because of that predominantly? And then we'll come to the other factors as well, of course.
Right. So unfortunately, we don't need a recession in the West to have major headwinds in our part of the world. Interest rates have gone up. They're going up much more than they have so far in the second half of the year. I think that can be said with a high degree of confidence. We probably will see 50 or 75 basis points in rate hike next month out of the US, and then follow that up with another few chunky interest rate increases in the remainder of the year. This is a big shock, and let's again put this in context. US inflation right now is running at about 8.5%. Thanks to base effect, that inflation rate will head toward 5% or perhaps even 4%, depending on how things go by the end of this year. So that's a 300 basis points of disinflation we're looking at, during which time we're talking about perhaps another 300 basis points of interest rate increase. That means real interest rate increase of 600 basis points in the span of half a year or a little more. That is an extraordinary amount of delta for the global economy to absorb. already we are seeing currencies under pressure in the region. We're seeing capital flows dry up. We have looked at, the equity market basically is an outflow in the last few months or so. Same with bonds. We are seeing corporate credit spreads widen. And these are all in reaction to what has happened so far. So you can only imagine what will happen in the next 6 months with respect to spreads and FX and so on, if indeed we're going to have this 600 basis points of real interest rate increase in the US vis-a-vis the rest of the world.